Hello, my name is Adam Kahn, and this is my half-assed channel. Usual disclaimer, not a financial planner, I'm not an accountant, and I'm not a lawyer. Please use any information I provide on the channel as entertainment purposes only, and reach out to your professionals for any financial decisions you make. That being said, well, quite a week, a lot of up and down as usual. Nice to see the market ending up on a pretty positive note. I think we'll continue to see it, like I've said. The negativity is pretty good. It gets me scared each time it drops as well. So I think you'll continue to see bull market breaks, nice big down moves. It'll be good buying opportunities that who knows how big or how long or whatever they last, with the potential for one to really follow through, because there is a potential for some negativity. But I still want to be the guy buying from the people who want to sell, and right now markets are still nervous. To be fair, I think there's probably not a whole lot of people even trading. I think a lot of people sold and they're just sitting and waiting until they're more comfortable, which is why I think it'll drift higher and it'll fall quickly to scare out anybody who's not buying investments that are just trading. So those of you who are a little bit more active, we'll talk about a strategy that I like to use, which is selling puts to get into a stock. And I'm just going to use a fictitious one because I don't want to really give any specific ones, but I want to give an idea of why I like the strategy. So we'll pick stock make-believe, and we'll call it a $100 stock. Now, if you're not familiar with options, there are calls and puts. Calls are bets that the stock's going to go to the upside. Puts are bets that they're going to go to the downside. Or they're used in insurance in some respects. So let's say you own stock make-believe and you're nervous it might fall. Maybe you buy a 1 month out $90 put as protection from the stock falling. Because what the $90 put is, it gives you the ability to sell the stock at 90 if it falls below there. So maybe you spend 50 cents, $1. It depends on the volatility of the stock, along with the time frame to when the option expires to determine the price of the option. Now, like insurance, these generally have a premium built into them because people buy things to protect them. You're generally getting paid a profit to sell that, right? Is the way I look at it. I'll go into now the company where I get my quotes from. It'll tell me the volatility, and I tend to stay away from anything that has less than a 20 volatility on the option, just because you're not getting a lot of premium. Doesn't mean I won't trade any of them. I mean, I did it in Philip Morris. Maybe it's in the 20s, it would be my guess. I haven't looked, but I'm really comfortable with the company that if I get stuck with the stock, I'll just own it for a little while, and I'll explain swing trading because I'll tell you what I do from there. Anyway, the point of that is the person paying that protection, you get to sell the put to them if that's a strategy you like. And the opposite side of it, you collect the premium. So let's say it was 50 cents and you sell one option, which is on 100 shares, and you get $50. Well, it doesn't sound like a lot, but odds are, if you're doing it properly, your hope is that it doesn't even get there and you get the $50 and you don't do anything. Now, I do what I call covered puts. If I sell a $90 put, I make sure I have $9,000 in the account in case I get stuck with that stock. My hope is that I don't. My hope is that I collect the 50 cents, I make $50, I find another put to sell the next month, and I collect that money. I guess you can get upset if the stock goes from 100 to 130 and think, geez, I wish I just bought the stock. But the reason I like selling puts in options is when you sell an option, you get the premium, which has time decay, volatility. It also has, theta, gamma, delta. It's all of these Greek terms that get built into the pricing of an option. And most people like to buy options because they're gambling either the stock's going to go up or they're buying the protection. I want to be the guy selling you insurance. Now, what I tend to do, I pick stocks I like and I'm comfortable owning. So in my stock make believe, it's a company I want to own anyway, and I already think it's low. So I'm selling the $90 put because if I get filled on it, I don't mind owning it. If I get filled on it, I then reverse and I start selling the calls against it, wherever time frame and whatever price makes sense to me, depending on what I wanted to do with stock make believe. If I thought it was trading between 90 and 120, and I start selling the $90 put when it gets around 100, and I get filled because it expires and it's at 88 or 85 or 80, well, maybe I don't want to sell the call unless it's an $110 call. But I'll reverse and I'll start selling the calls and collecting the premium from that option as well. But I'm okay holding the stock.